In this video, guys, we're going to talk about trading bias. Stay tuned. Hey traders, a very warm welcome to you. Thank you for joining me. All right, so trading bias creeps into our trading without us knowing it. And listen, I don't think we can eliminate it completely because we're human beings, and human beings are generally going to have bias in one form or another. That's just the way that we work. That's kept us alive for many years. But in trading, it's not very useful. But as with all these things, as long as we can be aware of it, recognize it's happening to us and step out of it and put it to one side, it's not going to be a problem. So the point of this video, guys, is to recognize when you have a bias creeping in. Now, I've got some kind of names for these biases, and it's almost hundreds or so different types of biases out there. But the important thing is that whatever influence we have, which we'll look at in a second, is that we don't disregard just the information, that we stick the clarity of focus of, hey, this is the information. Is there everything else is irrelevant? What is this information telling me? Easier said than done, but that's our ultimate goal. So example could be, right, if we see this candlestick pattern now, we know that this is a bearish engulfing candlestick, right? It's kind of engulfed the whole of the prior day's range. Now, most people would look at that if you were objective and go, that's bearish. But you might, if you were some way swayed from previously that this was a good company, let's say you've had dealings with them, let's say it's just a retail company, for argument's sake it's a stock, you like the store, you like the product, let's say it's Apple, you like the product, you like the stuff they're selling, and so your bias is that, well, it's a good company, it's not going to be bearish. I know it's extreme, and traders, we're unlikely to do this far, but you get the point. We get someone looks and goes, well, it's just bullish, it's only a little pullback from highs, it's bullish. You know, we had a lot of the crypto guys doing this, a lot of the cheerleaders for crypto, you know, when we're pulling back, and it was, you know, very bearish kind of objectively if you're looking at pure price action with no real thought on crypto. Whereas the guy, you know, a lot of the guys are saying, well, you know, it's still bullish, that's bullish actually, because it just means that it's getting a new base. And you could see a lot of people, and a lot of these guys were relatively new to speculation as well, so you could see a lot of these biases creeping in. They definitely had a real bias towards, you know, bullish on crypto and blockchain, but didn't see actually that, you know, times is so important. In other words, you know, you could be super bullish on an instrument, but it could come down, you know, halfway before it goes up again. And so having a neutral bias allows you to get a better price for your longer term thesis. A thesis and a bias is two different things. So, you know, the idea is, guys, is that we need to recognize it. So stuff like recency bias. So if you've had a trade on the long side, or you've been trading it, and that will influence your decision because it's the most recent data point that you can grasp. It's the most recent thing that you can think of, and often that might have a bias on your next decision. Then you've got stuff like, which is slightly different, these are more kind of from a gambling perspective, but you get things like, and you see this at casinos, hot streak. So you think you're on a hot streak, you think that, well, the next trade I do is probably going to be good because I've had a really good run, and you tend to might disregard the risk. Now, it's slightly different from having an opinion whether it's long or short, but it's an opinion on you as opposed to a stock or a market. Then you've got gambler's fallacy. So gambler's fallacy, who's saying that, you know, the market, or the roulette wheel specifically, and gambler's fallacy is that, you know, if you've had 7 reds in a row, you're bound to get a black next. But it doesn't work like that because each spin is independent. Slightly different in the market, but if you've had 3 down days in a row, you know, people might say, or 3 losing trades in a row, or the next one's got to be a winner, isn't necessarily the case. Now, I slightly want to step back because there are studies that show the stock market does have memory, and of course that's how, you know, a lot of technical analysis is done. So if we have 5 down days in a row, then statistically speaking, there's probably statistics that say number 6 is X% chance of being a down day update based on previous history. But, you know, forget about that for a moment. The fallacy is that someone will think that each thing is independent. So watch out for that one, more specifically for gambling, but you've got to be careful, all types of fallacies and biases coming in. Automation. So what's automation is that, automation bias is that if you have a decision that's made by an algo, and you could say automation / signal in the same kind of thing. If you think, well, this system's been doing very, very well, and it spits out a signal. You think, well, it's going to be really good because it's been doing really well, and put more money into it, ends up being a loser. You're biased based on the decision. Same with automation. If you've got some sort of algo running that's spitting out a decision for you, you might put more weight onto that decision because it's an algo, and an algo is probably going to be right. So it depends on what you're doing, of course. Then you've got the herd bias. If the crowd is thinking in one direction, then human beings tend to go with the crowd. And whilst that can be the right thing to do in terms of objectively trading, hey, the crowd is driving this, it's the most money is made when you are observing the crowd from behind and going, the crowd's moving forward. Now the crowd's getting a bit carried away. Okay, I'm stepping out of it, and I'm going to wait for the crowd to get to euphoric state and then maybe take a counter trend trade on that. So not saying we don't go with the crowd when the time's right, but recognizing that the herd can exhibit a bias or influence us with a bias. Confirmation bias is that, you know, we often look for something to confirm our additional bias. So this is a bullish market. Oh, I knew it was a bullish market because now it's even pushing higher, and that means it's bullish. And whatever you see, you add as confirmation or you ignore. So you might be bullish, have a bullish bias, and then you see that and you ignore that. But then the next candle you see is a little green candle. You might say, oh, there you go, look, that's a bullish market because it's this, and you end up looking for things to confirm what you already think, as opposed to looking at things objectively neutrally and saying, listen, my thesis is bullish, but I'm seeing something bearish at the moment. So we've got a bit of a supply-demand imbalance potentially. Let's see where this goes. If I see some support, then I might take the trade. So it's thesis as opposed to bias. Then we've got things like anchoring. So that's based on where we potentially took a trade, what we've done before. It's anchoring based on something. And this is a kind of psychology that many people use for pricing. You know, when a marketing company works with a retailer, for example, they'll anchor the price and say, well, you know, this is the price, it's $1,000, and that becomes then your focus point, your anchor. And then further down the line, they'll say, okay, well, actually, you know, you can get it for $300, and because you've already anchored it and relieved that it's worth $1,000, and then whatever the sales pitch may be, whatever the spin may be, then goes, right, well, now it's only $300. All of a sudden, you're anchored there, you get it for $300, you think it's a great deal. So anchoring again in the market might be depending on, you might have bought the stock at, you know, $100, say, and that becomes then your perception of value for it, your perception of the true value for it. And of course, not true in the market because of dynamically changing second by second, minute by minute. So we've got to watch out for that. So anyway, these are all kind of different words and different names and stuff. But what I want to talk about in this video, guys, or what I really want to kind of the summary of this video is that you have to really be mindful that this can creep in. You know, I know from my own experience, literally the other day I was looking for a gap fill on a daily chart. I think it was the NQ, and I was saying, like, listen, this is a good potential opportunity. When we start to see that, there's a good chunk of change we made off that. But because I was careful that I recognized this early, but my bias then, if I'd have stuck with that bias, I would have probably missed out on multiple days of trades, multiple types of things. And when I got to that, I'd have probably been so frazzled by trying to force that so much that it wouldn't have been a good week. However, you know, you say, listen, this is a setup and my bias isn't anything. My thesis is this. And yes, we talk a little bit about bias and say, well, I've got a bullish bias on stuff, and that's, you know, appreciate that slightly different the way we're kind of wording that. But the point is, it's really a thesis. And yes, we might think, okay, longer term bullish, but it's not to say it's not going to be short term opportunities to the short side. It's not going to say that we're not going to get multiple different types of trade before that happens, and it might not even happen the first attempt, third attempt, fourth attempt. In fact, it kind of made a couple of attempts over multiple days before it actually did. So fortunately, you know, being able to spot that and say, well, you're biased because you're always looking for that, always looking for that, always looking for that. Confirmation, you're anchoring from this point, etc. So just be aware, guys, it's a fine line, and I appreciate this, between us having confidence and a thesis and having some kind of bias in another kind of definition of the word bias. Is like, we've got a bullish bias, we're looking for pullbacks to buy pullbacks, but it's then being objective and not ignoring the fact that it's short-term bearish and saying, yes, that's our bias under that definition of a longer term trend. This may be short term bearish, right? But I'm still looking at all the stuff independently. Where's the best place to pull the trigger for the longer term long, rather than going, well, I'm ignoring that, I'm just pulling the trigger anyway. You know, recognizing it's short term. Now I might see it, now it's lining up with a longer term thesis and pulling the trigger. So just be careful of that, guys. Bias can creep in, and it can mean that we're stubborn as well about taking losses and all that kind of stuff. Anyway, guys, there's trading biases. Check your trading bias. See you next one. Take care. Bye-bye.